Hey creators, it's Jack at Essential. This time we're talking about something super exciting, taxes and business setup. So we get a lot of questions from the creator community regarding how to set up their business and why. So first and foremost, if you're a creator, business is generating income, you got to get incorporated. There's a lot of reasons why. The first one, I think the most important, is liability protection. So if your business gets sued, incorporation separates you, the person, from your company, from your business. So your personal stuff, your house, your car, your savings, that stays safe from anything going on with your company. Second, you can save big on taxes. No one wants to pay more in taxes. I'm going to go into those details in a minute on how you set up your company. That can have a major impact on how much you end up paying to the government. Lastly, just having LLC or incorporated after your business name, it makes it look legit, especially with clients or advisors or even investors. Having that incorporation status definitely makes a big difference for them. Business setup. We get a lot of creators asking questions on LLCs, on S-Corps, and how they should set everything up. Well, it kind of depends on your income amount. So most influencers or creators that we see are solo props or single member LLCs, which means that they are paying a 15% self-employment tax on every single dollar that they're earning. That 15% is made up of FICA taxes, which are Social Security and Medicare taxes. Now, if you've worked your typical corporate job, you're going to pay that FICA tax, but it's only going to be 7.5%. You pay this 7.5, and your employer pays that other 7.5 to get to your 15. When you're self-employed, the IRS, the government, sees you as both the employee and the employer. So you're paying both halves. You're paying that full 15%. But once your company or business starts making above, let's say 70-ish thousand for the year, it's time to start thinking about changing over to an S Corp. And that's a major game changer. And here's why. With an S Corp, you can give yourself a reasonable salary that would only be subject to that 15%. So first part, what's a reasonable salary? That's something you're gonna have to sit with your CPA and discuss. You want to make sure that you're following IRS guidelines on what's reasonable and what's not. But let's say you have your business and it's making 100,000 a year. You sit with your CPA and they say, all right, 50,000 of that, half of it is a reasonable salary. You would take that 50K and pay yourself a salary, a W-2 salary. The other 50K would not be subject to self-employment taxes. That would be an owner distribution. So in the example of a standard LLC, your company makes $100,000 a year, 15% of that, 15 grand out the door for taxes. If you set your LLC as an S Corp, you taxed as an S Corp or just a straight S Corp, your company makes 100K, half of it you take as a salary, which would be subject to that 15%. The other half would not. It would be an owner distribution. So right off the bat, the setup of your business, changing over to an S Corp, you just saved $7,500 in that example. Now, changing over to an S Corp does have operational expenses that you normally wouldn't have. One, you're running a payroll, so you got to get a payroll platform or payroll service to do that. Two, you're going to have to file an S Corp tax return at the end of the year. It's a little bit more labor intensive. Your CPA or your tax advisor is probably going to charge you more for doing that. But let's say that averages out to be about $1,500. Still, you would still see a savings of $6,000 just by taxing your business as an S Corp. So we hope that gives you a little bit more insight on how that all works. Feel free to send us any questions or drop us some info and some content. We're always excited to help the creator community. Essential is a PEO built for creators by creators. Hit the join now button to see how Essential can help you protect and build your business.